Hello, and welcome to the Weekly Watch. I'm Brian Daingerfield, the co-head of G10 FX Strategy and NatWest Markets, filling in for John Briggs. Ongoing lockdowns in China and the war in Ukraine continue to present risks to the outlook, including downside risks to activity and upside risks to inflation due to higher commodity prices and even longer supply chain disruptions. Amid these growing risks to the outlook, both the Bank of England and the Federal Reserve made policy decisions over the past week. In both cases, the market reacted dovishly as both front-end interest rates and currencies in each economy declined in the immediate aftermath of the decisions. But the tone of the two decisions could not have been more different. Starting with the Fed, which hiked the policy rate by 50 basis points and announced it will begin to run down its balance sheet in June, the dovish market reaction did not reflect a fundamental shift in the Fed's outlook for growth and inflation. Instead, it was simply a function of market pricing. The market set a hawkish bar that was just too high for the Fed to hurdle. By strongly suggesting that a larger 75 basis point interest rate hike is not something that the Fed is actively considering, the Fed pushed back on market pricing for more aggressive Fed action in the near term. That signal inevitably opened up the question of if we are finally at peak hawkishness from the Fed. It's not hyperbole to say that this was the first dovish surprise, at least compared to market expectations, from the Fed in the past 6 months. The market reaction to the Fed decision was masked what was otherwise an extremely hawkish communication from the Fed. Taming runaway inflation is clearly the Fed's #1 goal. And aside from the pushback on 75 basis point moves, almost every word out of the Fed on Wednesday reinforced that goal. I think part of the reason why the Fed can stay so hawkish is that global growth risks are simply not as strong a negative impact on the U.S. consumer, given the strength of the consumer and relatively low direct exposure of the U.S. to exports and global growth. Simply put, the U.S. does not have a strong of direct exposure to either China or Ukraine, and the same cannot be said of other major economies in Asia and Europe, including in the UK. On that note, I'm pleased to be joined by Imogen Bachra, our head of UK rate strategy, to discuss the Bank of England decision on Thursday. Imogen, can you reflect on the Bank of England decision? What did they do, and what was the market reaction?
Yeah, of course. Thanks, Brian. So it was an interesting meeting today. I think, as a headline, the Bank of England hiked by 25 basis points, but that was pretty much nailed on by markets going into this. It was, fully priced in everyone's base case expectation, really, that they hiked by 25 basis points. So the market reaction was always going to be driven by how they delivered other elements of this. And although that headline, a hike, and actually the vote with which that was delivered was hawkish as well. So we had 6 members voting for a hike of 25 basis points, but 3 members voting for a hike of 50 basis points. Taken together, those two things are quite hawkish, but actually on all other elements, they were fairly dovish. So if you look at the inflation forecast over the 3-year horizon, using the market implied rates, they expect inflation to undershoot significantly versus their 2% target over the 3-year horizon. That got revised down from 1.6 to 1.3%. They revised down their 2- and 3-year growth forecasts as well, quite significantly. And really they show, stagnation pretty much over that kind of 2- and 3-year horizon. The guidance around future tightening was also diluted. They recognized that some members felt that there wasn't really a need to suggest that there might be further guidance and further tightening, in the future. And also on quantitative tightening, they were, in line with our expectations, but probably slightly leaning to the dovish side of consensus, in that they told us that, they would report back in August, and only after August, at a subsequent meeting, would they announce whether or not they would be undertaking active sales. So all of those elements together, I think, added up to a fairly dovish hike.
So on that note, it's very clear that the market took this decision quite dovishly, and gilt markets have responded accordingly. We've seen significant moves lower in gilt yield, particularly in the front end. Do you agree with that market reaction? Certainly, we're recording on Thursday, just in the aftermath of the decision, and so clearly we've had a pretty big snap move. Do you think that's the right instinct here?
Yeah, you're right. I mean, we are recording this literally an hour after the meeting, but the knee-jerk reaction has been significantly lower across the curve, led by the front end. I think if you look at 2-year gilts, they're probably about 25 basis points lower now, or 1 year is roughly about the same. And in short, yes, I think that is the right reaction. We've been arguing for a long time that market pricing was completely disconnected from Bank of England's guidance. It's getting closer now with that kind of additional hike that I say we've priced out now of over the near term, but I still think there's much further to go. As a result of today's meeting, we leave our kind of expectations of near-term policy unchanged. So that is one additional 25 basis point hike later this year, and then probably at least a pause into next year. And we haven't yet added in any more hikes next year. I think that's probably a risk case, but there's nothing in today's meeting to suggest that that's a growing risk case, just the risk case. And for quantitative tightening, we expect this, our expectations heading into this meeting were for announcement in Q4 with active sales to begin not before 2023. So there's nothing about today's meeting to alter those expectations. And that was really a long way from where market pricing was. So I think that reaction today is the right one, but I still think that there's further to go. So, heading into this meeting, for those that are in the market, we had trades on like receiving 1 year. And I still think that there's a lot more juice in that trade. For context, markets are pricing still after today 100% chance of a 25 basis point hike at the next 3 meetings, June, August, and September, whereas we think there's only one, potentially with risks of 2, but certainly not 3. And so being long something like the September dated MPC also looks attractive to us, given, if we are to get 2 rather than 1, I think it's much more likely that they come in June and August, and not September.
So it certainly feels like we've passed peak hawkishness from the Bank of England, and we're sort of wondering if we're at that point with the Fed. It certainly feels like we're at that point with the Bank of England. But what do you think the risk is on the other side? What do you think would be needed to push the Bank of England back into a more hawkish direction and maybe push the Bank of England back in line with where the market is rather than force it the other way?
So the things that we'll be watching, I guess, in the very near term are the inflation prints. How quickly we have the peak in our inflation forecast in April. So this month's data that we'll be seeing in a couple of weeks. But beyond that, although it does come down, it doesn't come down particularly quickly. So it'll be very key to watch whether there is a turning point in April and how fast that does come off. So that's the kind of near-term indicators, I suppose, that the Bank of England obviously too will be watching. And over the longer term, I think this will be more about wages, and how sticky they are and how they feed into inflation, because that's what will really drive whether this inflation persists for longer than we're expecting, I think.
Thanks, Imogen. And I certainly agree on the inflation prints, and that feels like it's going to be the big point in the week ahead for the US. When we think about the upcoming data calendar, the CPI next week is probably going to be very important as we think about, are we at peak hawkishness, both for the Fed and for the Bank of England? And for what it's worth, our economists actually expect an acceleration in the monthly core CPI in the data that we will see in the coming week, which would certainly be bad news for the Fed and may sort of bring back this concern that we might not yet be at that peak hawkish point. And in the UK, first quarter GDP is among the headlines on the data calendar next week as well. So on that note, thank you very much for joining us, and thank you for listening. If you enjoyed this podcast, please like and subscribe to our channel for more NatWest strategy content. Thank you.